Greetings, everyone. Scott Richardson, Dan Brown from Richardson Capital Management here to provide the 2024 first quarter economic and investment update. A little hard to believe we're already through the first quarter, went awfully quick. Good news is financial markets performed very favorably during the first quarter, and the gains were pretty broad based in certainly the equity markets. The fixed income markets were a little bit more muted and mixed as interest rates rose a bit during the first quarter. And with that, Dan, give us a little update on kind of how things maybe broadened out and kind of how things looked, across the board.
Yeah, thanks, Scott. So one thing we talked about in our investment letter last month is that we expected stock returns to broaden out. So looking back at last year, 2023, it was really just a information technology led performance for the year. And this year, and what we talked about last month is that we expected those returns to broaden out to other sectors. And sure enough, in the month of March, we saw that. And for the full first quarter, we saw that. So for example, we saw some lagging groups from last year, financials, industrials are leaders this year and actually outperforming the broader market and the tech sector. We still expect good things from the tech sector, but we're encouraged by the fact that the rally is broadening out. So we saw a new bull market initiated in January as the S&P 500 surpassed its prior high from January of 22. So again, another very positive characteristic that we're seeing. So we're still seeing economic growth remain strong. Q1 GDP is trending at about 2%. Corporate earnings very solid. We talked about that last month. And we expect the Fed to reduce interest rates sometime this year. And as far as fixed income is concerned, so investor expectations for Fed rate cuts has been pared back.
Yep.
So that's why we saw the very modest losses for Treasury securities. But on the corporate side for corporate fixed income, very strong as corporate earnings remain very healthy.
Dan, you mentioned the rise in interest rates because expectations have changed a bit regarding Fed rate cuts. Can you talk a little bit more in detail on that? We had a Fed meeting in March. We got a little bit more guidance. Give us our thoughts on what's the expectation going forward here.
Yeah, so more broadly, just looking back over, say, the past maybe 4 months or so, we kind of started the year with investor expectations that the Fed was going to cut rates maybe 6 to 7 times. And if we talked about and we wrote, we thought that was a little bit too aggressive. And what we learned in March is kind of what we learned, the past couple months, and that is the Fed only really anticipates to cut rates maybe 2 to 3 times.
Yep.
And they reinforced that at their March meeting. And we're showing a graph here that looks at why we think the Fed is going to remain cautious and patient with rate cuts. And basically what we're showing with the graph is that the Fed is very much a student of the markets and financial market history. And we're looking back at the decade from the 1970s. And looking back at this, I think most investors would say that the Fed was a little bit too aggressive in cutting rates in the mid 1970s. And what happened is that led to a resurgence of inflation later in the decade. So again, we think the Fed is keenly aware of this and they don't want to make that same mistake of the 1970s. Therefore, we think the Fed is going to remain very patient with rate cuts. So we're still expecting rate cuts this year. We think 2 to 3 is probably about right. And June, July timeframe, we think is about right. But again, it's interesting that investor expectations for rate cuts have been pared back quite a bit in the first quarter, but yet financial markets performed just fine, as we talked about. So Scott, a very solid start to the year so far. So we talked about financial markets performing very favorably. We're expecting Fed rate cuts sometime to begin in the middle of the summer. Where does that leave us for an outlook?
So I think it's interesting to look back a year ago and the fact that the majority of economic and investment professionals thought we were definitely heading into a recession, and the only question was the timing and the magnitude of it. Fast forward 12 months, growth remains strong, inflation's trending in the right direction, labor market still seems pretty strong, and as a result, I think the narrative has changed, and we, along with the majority of the investment and economic professionals, are now thinking this soft landing is probably the most likely outcome. Soft landing referring to slowing growth, but no recession. And so we're still now, we've the last several months turned the corner and are feeling pretty optimistic that the soft landing is in the cards. I think the key takeaway for everybody is the fact that, the performance the last 4 to 5 months has been exceptional. And the likelihood of that repeating at that same magnitude and pace is unlikely. But I think we're of the opinion that, going forward, we're still expecting positive returns in the financial markets. albeit at probably a more muted and slower pace. And it might, be a little bit choppy, but still have a positive outlook and feel good for the rest of the year. So with that, I want to thank everybody for joining us. As always, if anyone has any questions or concerns, please don't hesitate to reach out to us. And again, we truly appreciate all the continued trust and support.